Hello, everyone. I'm Josh Albayero with IOOGO, and today we're going to talk about the real estate, local taxes, and mortgage interest. So, there's a lot of homeowners in our audience, so I know that this is going to be a very, very popular topic. If it doesn't pertain to you, but you know some people who may be looking to buy a house, maybe bought a house last year, they still haven't done their taxes, pay attention to this and maybe share it with them so that they can learn how the whole process of tax deductions work for homeowners. So I want to start with adding a little bit of, there you go. I just added a little fun to the video. We're going to be talking about state and local and real estate taxes today. And the first thing that I want to talk about is the situation where you are confused and you don't know, what can I report? What am I allowed to report? Because the real estate agent and the loan officer told you that you could have reported all of these things, right? And now you're confused. Maybe you forgot, right? So let's start with the limits, because that's the less fun part. We'll focus on the fun part. So let's focus on the fun part first, because the fun part is what you want to hear, what you want to know, and then let's talk about the limits and all those things later. So, all right, number one, let's talk about interest in the real estate deductions. How do they work? How do we enter them in the system? How does this magical deduction happen? All right, well, remember, if you own a mortgage, if your home is mortgaged and you are paying the bank, whatever bank, credit union, you are going to receive a document at the end of the year. That document is going to have your interest that you paid on the loan. So if you have a $200,000 loan or $300,000 or $100,000, whatever, that form, it's typically form 1098. The bank will send it to you and say, hey, here, this is how much interest we received on the payment. Every month you pay your home mortgage, and then this was principal and this was interest. Well, this interest right here is going to be lump sum there. Sometimes it's like $3, $4, $5, $6, $10,000. That interest there, it's something you can enter in your tax return as long as you are able to itemize. Okay, and you're gonna hear me say that a lot today. So as long as you're able to itemize, then you're gonna be able to report your home mortgage interest. And the other part to being a homeowner is real estate taxes, right? Your local real estate taxes. You paid your local government, whether it's the county or the city. You pay property taxes, and sometimes those property taxes get rolled into the house payment and the interest, so you get only one form from the bank, and the bank sends you the form and says, hey, look, your payment was $1,500, but out of this $1,500, $1,100 went to principal, 300 went to the interest, and 100 went to the property tax. And I'm just making this as simple as possible, right? So what usually happens is that you paid your principal and interest to the bank, and then you pay separately your property taxes. You get a bill from the tax assessor from your county or your city, and then you pay them separately. That's typically what happens. But those two expenses that you have throughout the year can be added to your tax return as long as you are able to itemize, as long as you qualify. Okay. So what does that even mean? If in taxes, in tax preparation, every year we get a choice. Either we take the standard deduction or we take the itemized deductions, right? Standard deduction means that a lump sum of money that that I earned is going to be ignored for tax purposes. That's a good thing. So a lump sum of money is going to be ignored. So that means that the IRS is going to act like as if they don't even see that money, and because of that, I'm going to pay less taxes. Itemized deductions means that I have to tell the IRS line by line what are those qualified expenses that I have, and this one needs to be higher than this one in order to be able to itemize, right? So I'll give you the example. Let's say that Christy and I are married and we get $24,000. That's what the government says, $24,400 in deductions, in standard deductions. So Christy and I are married. Because of that, we get $24,400 in standard deductions. Included in there is any possible home ownership. You hear that? Any possible, because even if I'm not a homeowner, that $24,400 applies to me. Any medical out-of-pocket medical expenses, any possible medical expenses are included there. Any possible charity donations are included there. So let's say that you and I are married, and we made income of $75,000 last year combined, but because we're married, that's our filing status, we get a $24,400 deduction. So what's our taxable income? $50,600. So that means that we are going to pay taxes on $50,600 and not on the $75,000 we earned. You see how that's positive? That's a good thing, right? All I have to do is go into IOOGO tax, tell the IRS that Christy and I are married, and tell them how much money I made, and instantly they reduce my income by $24,000 and only calculate taxes on the remainder, which is $50,600, right? Those $24,000 include any possible deduction like a home mortgage, interest, charitable donations, and things of that nature. Right now, let's switch to something different. Right? Let's talk about your rich uncle Christy, and then your rich uncle Michael and his wife Donita. Michael and Donita, they earned $250,000 in income, right? And they also paid $30,000 in property taxes, okay? Because they have a really large home, right? $30,000. But guess what? The government says, I don't care if you pay $30,000. We're capping that at $10,000, right? So what's the only deduction you get? $10,000, right? So let's say that because they have this big huge mortgage, they paid $18,000 in interest. That's what the paper that they received. So how much money do they have so far right now in deductions? $10,000 plus the $18,000. That's what, $28,000, right? So let's also say that Donita was sick. So because she was sick and the insurance didn't cover certain things, they spent $30,000 out of pocket expenses, right? So $30,000 out of pocket expenses. So now they have $58,000 in itemized deductions. Which one would you take? The itemized $58,000 or the $24,000 standard deduction? Right, so it's that simple right now. So you see what I'm saying is you need to have a lot more. So here I'll give you we'll make another example. Let's say that your cousin Jesus has a job where he and his wife doesn't work, he works, and he has a job, and he earns $48,000. That's it, $48,000. With $48,000, they also have 2 kids, right? So because they file married jointly, their standard deduction is what? $24,400, right? In 2019, $24,400. And medical expenses out of pocket, he has zero, right? And a home mortgage, he owns a mortgage, so he pays $2,000 in interest throughout the year on his mortgage, and he also pays $1,200 in taxes, property taxes, and he gave $1,000 to the church. What do we have there? $4,200, right? So that's all I can itemize. Which one's more beneficial for me, the $4,200 or the $24,000 standard deduction? So where would I put how his net salary or his salary is $48,000 minus the $24,400. Where he's paying taxes on what? $23,600. So that's basically how it works. So you let the system do all this math, right? You're basically going to tell IOOGO Tax, hey, I'm married. This is how much I made. And IOOGO Tax is going to ask you, do you have any more? Are your qualified expenses any more than $24,400? And you're going to say yes or no. If you say yes, it's going to begin to ask you questions about those qualified expenses. And what are those qualified expenses? They are your medical and dental expenses that exceed 10% of your gross income. An example: if you earn $50,000, your medical and dental out-of-pocket expenses need to be more than $5,000, right? Home, real estate, and local taxes. That's another one. And the charitable donations, like giving to the church, and in some cases the casualty losses. But in order for you to claim casualty losses nowadays, you have to be in an area that the president has declared what do they call it, disaster area. So it sounds like I just went through the standard deduction episode again, right? But it's important for you to understand that the standard deduction is what really rules, right? So if you get the paperwork from your mortgage company and your property taxes, and you combine those, and and let's say that once you combine the amounts, let's say that you have $12,000 in itemized deductions, and your standard filing jointly deduction is $24,400, then you just simply click on this and you're done. You don't have to enter all this other stuff anymore. That's what the tax law changed. The tax law, before they passed the law, they made a study, and then they realized that most people were just entering things in there that weren't really making any changes for them. So what they did is they doubled the standard deduction. So if you're single, instead of a $6,000 deduction, now it's a $12,000 plus deduction. If you're married, instead of a $12,000 deduction, now it's $24,400. If you're single with dependents, instead of a $99,000 standard deduction, now it's $18,350. So this is why you're going to have complications whenever you are trying to report your home and your local and real estate taxes, because it's already included in your deduction. So again, take a look at your filing status, and that's going to tell you. And simply Google it. You can Google and say, hey, what's my standard deduction if I'm married? And the first thing that's going to come up is going to be the IRS, and it's going to tell you that if you're married, your standard deduction for this year is $24,400. So that means that any other expense that you want to claim has to be above that before it begins to have any effect on your tax return. Now, to end this, I want to ask my real estate professionals out there and loan officers. I'm going to say that there's 99.9% loan officers and real estate agents who are legit and who are honest, but then there's, like in any industry, there's that one guy who's going to tell their customers anything to close a sale. And stop telling customers that they are going to get a huge tax break if they include their closing cost and their down payments in their tax return, because there's nowhere in the law for us tax professionals to enter that information. There's no provisions, right? Maybe they existed in the past, but they don't exist anymore. So there are credits like the MCC credit, the mortgage certificate credit, that has to be done throughout the purchase, like as you're purchasing the home, And there is a credit. That credit is done for folks with low income, right? So that credit, will help you reduce your tax liability, and in some cases increase your refund. But that has to do with interest and how much interest you paid, and not with closing costs, and not with down payment. So for those of you taxpayers who are out there looking for a home, be careful, right? You don't want to fall into these traps, because then at the end of the year, when you are either doing your own taxes or you go to a professional, we're going to have a hard time finding those provisions, because the law, right? We all use the same law. We're not going to be able to find those provisions. All right. I hope this was helpful. If you want to know more about taxes, if you want to, understand, taxes are simple. It's just simple understanding what I can do and what I cannot do. Go to our YouTube channel here. I'm going to give you the link right there. You can go to our YouTube channel, and IOOGO Inc. You can see the rest of the podcast there. But today, we're going to leave it here. We're going to keep it short. So thank you so much. We'll see you next time.